Welcome back. The aim of this lesson is to learn about the statement of profit or loss. The learning goals are for you to be able to explain its purpose, identify business income and business expenses, and calculate gross and net profit. The statement of profit or loss shows whether the business made a profit or loss during a period of trading. They're produced at least annually for external reporting, but can be produced for managers to cover any period of time. The statement of financial position shows the financial structure and health of a business at a certain point in time, what's been invested and borrowed, and how it's been used. Both of these financial statements are connected to the double entry bookkeeping system. In this lesson, we are going to focus on learning about the statement of profit or loss. The statement of profit or loss is the easiest financial statement to understand, as we simply deduct the business's expenses from its income to calculate profit or loss. Profit is earned when the income is greater than the business's expenses, and a loss occurs when the expenses exceed income. The production of financial statements is highly regulated to ensure companies do not mislead us and to help us to be able to compare the financial statements of multiple companies. The rules a business adopts or is required to follow will depend on where it's located and where it trades. Accounting rules might differ slightly, but generally they all follow the same principles. We'll not focus on specific rules, but we will be learning about the general principles. For us to be able to accurately process transactions in the double entry bookkeeping system, we need to be able to identify the business's income and expenses, and those that are permitted to be recorded in the statement of profit or loss. Let us start with income. Income is the revenue earned from the ordinary profit-making activities of a business. The bulk of a business's revenue comes from its trade, the sale of its goods and services. But sometimes there are other types of income, such as interest received, perhaps from bank deposits, commissions and royalties, amounts paid by someone else, perhaps for promoting or selling their products, and dividends. This is income that can be received as a return on an investment in other businesses. The statement of profit or loss begins with recording the total amount of income earned during a period of trading. The figures are taken from income accounts in the double entry bookkeeping system. They are used to record income as it's earned. At the end of a trading period, the total is calculated and the figure is recorded in the statement of profit or loss. We will be learning about how to use these accounts later in the course. To avoid bookkeeping errors, it's essential that we can correctly identify income, because cash flows into the business in other ways too, but not all cash inflows are recorded as income. For example, a sole trader may invest more cash into the business, or they may receive a bank loan, or receive money for selling something of value that the business owns. These types of transactions are not ordinary, everyday profit-making activities, so they cannot be recorded as income in the statement of profit or loss. Now it's time for a question. Please pause the slide, read and answer the question, and press play once you're ready to listen to the answer. To identify income, ask yourself, what does a hairdresser do most days to make a profit? They style hair, rent chairs out to other stylists, earn commission from product sales, and maybe earn some interest on bank deposits. The other transactions cause cash to flow into the business, but they're not everyday, ordinary profit-making activities, so they are recorded differently. The business's profit-making activity causes expenses to occur, and to calculate profit, the costs are deducted from the revenue earned in the same period. There are many different types of expenses, but typically they include the cost of purchasing materials to make products or purchasing stock to sell to customers, the costs associated with running a shop, office or factory, the cost of employing people, as well as advertising, marketing, selling and distribution costs. In the bookkeeping system, a business can group together different expenses in a way that's most useful for them. For example, some businesses may want to monitor the costs for gas and electricity separately, so they'll have one account for gas and another for electricity. Yet, another business may put all the costs in one energy costs account. Cash flows out of the business in other ways too, and again, to avoid bookkeeping errors, we need to be able to identify transactions that are not related to the business's ordinary, everyday profit-making activities, as they are accounted for differently. Examples are a sole trader withdrawing capital that's from their initial investment, or taking drawings. If you recall from an earlier presentation, there's no separation between a sole trader and their business. They are not employees. So when they draw cash from the business, they are drawing from the business's profit or the business's capital. These types of transactions are not recognised as business expenses. When the business buys an asset, that's a valuable item that will be used in the business over a number of years, for example, purchasing new machinery, the whole cost is not recorded in the statement of profit or loss at the time of purchase. Neither is the repayment of loan capital. The accounting for these types of transactions is a little more complicated, and you'll learn about it at advanced levels. It's time for a question again. Please pause the slide, read the question, and press play once you're ready to listen to the answer. All of the highlighted costs are incurred by the everyday operating activities of the business. The owner taking cash from the business is not a business expense, as they're drawing from the business's profits. When a business invests in valuable equipment and intends to use it for a number of years, the whole cost is not recognised as an expense at the time of purchase. It's accounted for differently. The repayment of loan capital is also not recorded as a business expense. To summarise, for you to be able to process transactions accurately in a double entry bookkeeping system, you need to be able to identify the income and expenses that are permitted to be recorded in the statement of profit or loss. If transactions are not classified and recorded in the bookkeeping system correctly, the data in the financial statements will be misrepresented and cannot be relied upon. When learning about double entry, you don't need to be able to do profit calculations, but for completeness, we will take a look at a very simple example. The first line of a statement of profit or loss records the business's sales. From sales, we deduct cost of sales. This is what it has cost the business to make or buy the product or provide a service to the customer. For example, a car manufacturer builds cars, so the cost of building the car is the cost of sale. A supermarket sells produce, so for a supermarket, the cost of sale is what they've paid for the produce. A hairdresser cuts hair, so the cost of hands-on labour could be included as a cost of sale. Cost of sale does not include the general running costs or overheads of the business. So gross profit is what the business has earned after cost of sales has been deducted. Please pause the slide, read the question and press play when you're ready to listen to the answer. The clothes shop earns its income by selling clothes. The cost of sale includes the cost of buying the clothes they're selling. The bakery earns income from selling baked goods. The cost of sale will include the cost of the ingredients bought to make the baked goods. And a dog walking service earns its income from walking dogs. The cost of sale could include the cost of hands-on labour, so that's the wages of the actual dog walkers. To calculate net profit, we deduct other business expenses, which are also known as overheads. There could be a large list of overheads. We've just included a few to keep it simple. So net profit is the profit made after all business expenses have been deducted. Net profit can also be described as profit for the year. If you haven't done already, pause the slide and make some notes to help you complete the next activity. Pause the video, read the question and press play when you're ready to review the answer. To calculate gross profit, we deduct the cost of the ingredients for making the cakes from the revenue earned from the cakes we've sold. We ignore the bank loan as it's not a profit-making activity. To calculate net profit, we deduct the shop's overheads and employees' wages and salaries. We ignore the owner's drawings and the loan capital repayment as they are not business expenses. I hope you've enjoyed learning about the statement of profit or loss. In the next lesson, we'll be learning about the statement of financial position. Welcome back. In this lesson, the aim is to learn about the statement of financial position. The learning goals are for you to be able to explain its purpose, identify the assets and liabilities to be included, identify equity, more commonly known as capital in the UK, and use the accounting equation to calculate equity. We are learning about two important financial statements that are related to the double entry bookkeeping system. In the previous lesson, we learnt about the statement of profit or loss, which reports whether the business made a profit or loss during a period of trading. In this lesson, we'll be learning about the statement of financial position, which shows the financial structure and health of a business at a certain point in time. This is the financial statement that people generally find a little more difficult to understand, so we'll start by relating its purpose to our own lives. At some point in our lives, most of us will want to borrow money. When we borrow a large amount of money, let's say to buy a house, the lender needs to assess the risk of lending to us more thoroughly. To assess risk, a lender will look at whether we are financially stable. The indicators of financial stability include 1. Being able to pay our monthly expenses from our income without needing to borrow. 2. Having a surplus of income so we are able to repay any additional loans. Have you noticed? To calculate surplus income, we deduct our expenses from our income. It's similar to how we calculate profit or loss for a business. 3. Having an adequate emergency fund, usually recommended to be at least 3 months of living expenses. 4. Having little or no debt. 5. Having consistent or growing net worth. Let's take a look at what net worth is. Net worth is what we'd have left if we sold everything we owned and used all of the cash we have, including what's in the bank, to pay off our debts. The things that we own that can be converted into cash are called assets. Liabilities are our debts, what we owe to others, also known as financial obligations. Net worth is calculated as the sum of all of our assets less the total of our liabilities. Net worth belongs to us. For example, let's say the only thing you have of value is a house and its value is £250,000. The only debt you have is a mortgage on the house, and the amount still to be repaid is £200,000. Your net worth would be calculated as £50,000. This is the amount that would be returned to you should you sell the house. We are financially stable if our net worth is positive, so we have more assets than debt, and particularly if our net worth grows during our lifetime. If we have more debt than assets, then we have negative net worth, which can be an indicator of financial hardship. Get ready to pause the video to give yourself time to read and answer the question. The answer will follow. Assets are anything of value that can be converted into cash. A house that's owned can be sold and converted to cash. This cash can then be used to repay any mortgage that we might have on the house. The house is an asset, the mortgage is the liability. Cash also has value, so whether it's in your wallet or deposited elsewhere, it's also an asset. Get ready to pause the video again. Press play when you're ready to look at the answer. Liabilities are the financial obligations, amounts that are owed to others. The bank loan, credit card balance, and mortgage are all debts that need to be repaid. Please pause the video and press play when you're ready to review the answer. When we calculate the value of our assets, we include the full value of them, even if we have loans outstanding on them. So, the total value of our assets, including any cash we have, is £167,000. We add up our financial obligations, debts to be repaid, which totals £106,100. To calculate net worth, we deduct the total of our liabilities from the total of our assets. Our net worth is the amount that belongs to us. So if we were to sell everything we own, repay our debts using the cash we have, we'd have £60,900 left. Now let's look at how what we've learned applies to a business. A business's net worth is calculated in a similar way, only we use the term equity or capital to describe net worth. Capital is the term you'll hear most commonly used in the UK. It is what would be returned to the investor or investors if all the business's assets were sold and the debts were paid. A business's net worth is reported using the Statement of Financial Position. As we've learned, the preparation of financial statements is regulated, so there are rules about what businesses can classify as assets and liabilities. However, To help us learn double entry bookkeeping, we'll stick to simple explanations. So as a reminder, if it's something that can provide a business with cash, it's an asset. And if it's a debt that needs to be repaid, it's a liability. Get ready to pause the slide again to give yourself time to read the question and answer it. To identify an asset, ask yourself, if the business needed to stop trading, where could it get cash from? It can ask its customers to settle their debts, sell the office building, use the cash that's held at the bank, sell its stock, office equipment and computer equipment. Get ready to pause the video again. Can you explain what items A and F are and why? The business buys materials to make goods, or it buys ready-made goods from its suppliers, and they may have an agreement to pay for them later, which means it's a debt. The bank loan also needs to be repaid, so that's a debt too. Debts are liabilities, the financial obligations of the business. Get ready to pause the video again to give yourself time to read and answer the question. To calculate the business's capital, we deduct total liabilities from total assets, just as we did when we calculated personal net worth. The double entry bookkeeping system has an account for every asset and liability that needs to be reported in the statement of financial position. There's also an account which holds the balance for capital. When the report is being prepared, the accounts are totalled and the balance is recorded in the statement of financial position. Let's look at what can happen if a bookkeeper hasn't learnt double entry properly. Let's say a farmer buys a tractor. It's an asset, as it's valuable and it will be used in the business over a number of years. It should be recorded in the statement of financial position. The bookkeeper thinks it's an expense, so records it as an expense in the statement of profit or loss. This error will produce reports that are misleading, as profits will be £45,000 lower than they should be, and assets will be valued at £45,000 less than they should be. Let's say the business has a £50,000 bank loan. The business decides to pay all of it off. Instead of removing the debt from the statement of financial position, the bookkeeper records the repayment as a business expense, which results in profits being £50,000 lower than they should be, and the debt is still showing as outstanding in the statement of financial position. This question requires some explanation, so please pause the video in a moment. In the first column, we have some accounts that will be found in the double entry bookkeeping system. You are required to identify whether the balances on those accounts will be recorded in the statement of profit or loss as income or expenses, or the statement of financial position as assets and liabilities. The business's income comes from the products and services it sells, and sales are recorded in the sales account. It will be used to calculate profit. The purchases account records the cost of materials that have been bought during a period of trading to make goods to sell to customers, or the cost of ready-made goods. It's an expense account as it's deducted from sales to calculate gross profit. We learned about this in the previous lesson. It's worth noting here that this account is quite different to inventory or stock, which we've learned about in this lesson. The cost of purchases could amount to £500,000 during a period of trading. Much of this will have been sold to customers. The inventory account shows how much remains in stock at the time the accounts are prepared. The other expense accounts listed record the costs incurred as a result of trading, also known as overheads, and will be deducted from sales to calculate profit. The asset accounts record the resources the business has that can be turned into cash, so the business can ask customers to settle their debts, use cash and any cash held in the business, sell its office equipment and vehicles. And finally, liabilities are the business's financial obligations. Supplier debt and the bank loan both need to be repaid. Capital is also a liability as it belongs to the investor or investors and can be returned to them at any time. I hope you've enjoyed learning about the statement of financial position. In the next lesson, we will be using the statement of financial position to learn about the dual aspect of double entry bookkeeping. Welcome back. In this lesson, the aim is to learn about the dual effect of double entry. The first 3 learning goals are repeated from the previous lesson. In this lesson, we will be adjusting assets, liabilities and equity, and using the accounting equation to explain the dual effect of double entry. In the previous lesson, we learned about the statement of financial position, which is the financial statement that reports on the financial structure and health of a business, what's been invested and borrowed, and how it's been used. The statement lists the business's assets and liabilities. Whilst learning double entry, we can identify assets as things that have value and could be converted to cash. Assets include cash already held in the business. We can identify liabilities as financial obligations, debts owed to others. Here's the first question of the lesson. Pause the video and replay it when you're ready to review the answer. Typically, a business's assets might include property, motor vehicles, office and computer equipment, and inventory or stock. All of this could be sold to be converted into cash if the business needed it. Customers' debts will also convert to cash once they pay what's owed, and the business hopefully has some cash in the bank already. Typical liabilities include bank loans and debts owed to those that have supplied the business with materials or goods on credit. These are the business's financial obligations, debts that need to be repaid. Equity, also known as capital, is the business's net worth. It's the amount that could be returned to the investors if the business was to sell all of its assets and repay all of its debts. Equity is classified as a liability as it's owed to the investors. The calculation we use to calculate a business's net worth is called the accounting equation. Total assets less total liabilities equals equity or capital. Get ready to pause the video again to give yourself time to read and answer the question. The business's assets total £100,000 and its liabilities total £42,000. Using the accounting equation, we can calculate equity as £58,000. Please pause the video if you need more time to review the answer. In a double entry bookkeeping system, the total of the business's assets will always equal the total of its liabilities. The liabilities section shows where the money is coming from, investors, bank loans and other forms of borrowing, or buying using credit, and the assets section shows how it is being used. Perhaps the business has bought office equipment and stock and has deposited some at the bank. When processing business transactions in the double entry bookkeeping system, this balance is always maintained. Now we're going to learn about how we achieve this using the dual aspect concept. To become proficient at double entry, we need to start by carefully thinking through the effects of business transactions. Let's consider the effect if you borrowed money from the bank. The loan money will be paid into your bank account, but you'll also have a debt that needs to be repaid. What's the effect if you use some of the money to buy a car? Your bank balance would reduce, but you'll own a valuable car. What's the effect of settling a credit card debt? You'd have less money in the bank, but you'd have no credit card debt. The dual effect you see happening here is what we call the dual aspect concept in double entry bookkeeping. Every business transaction causes a dual effect which are equal and opposite. Get ready to pause the video so you can give yourself time to read and answer the question. Don't worry if you found this first one difficult. A friend is joining the business, probably as a business partner, and they're investing £50,000. It's likely to be paid into the business bank account, so the bank balance will increase. The equal and opposite effect is that capital increases. The friend is effectively lending the money to the business. At some point in the future, it may need to be repaid. So capital is classified as a liability. Please pause the video at any time if you would like more time to think about the answer, especially as the topic becomes more complex. The bank balance will reduce when the machinery is purchased. The equal and opposite effect is that the business now owns valuable machinery. Here, one asset, cash, has been exchanged for another, machinery. When the bank loan is repaid, the bank balance will reduce again. The equal and opposite effect is that the debt is reduced. Now we'll look at how these transactions affect the statement of financial position, as well as how the balance between assets and liabilities is maintained. Let's say you're starting a new business and you're using £50,000 of your own cash. You'll pay £50,000 into the business's bank account, so you'll create a business asset. The equal and opposite effect is the creation of a liability. The investment is recorded as equity or capital to indicate it's been provided by you, the investor. It belongs to you and it could be repaid at any time in the future. The dual effect of this business transaction has been double entered in two places. In the liabilities section, we've shown where the money is coming from, and in the assets section, we are showing where it is in the business. The total of the business's assets equal the total of its liabilities. Get ready to pause the video to give yourself time to read and answer the question. The funds have been paid into the bank, so the bank balance will increase, but you now owe the bank £20,000. Let's adjust the statement of financial position. The bank balance increases by £20,000, giving a new balance of £70,000. The equal and opposite effect is the creation of a liability, as £20,000 needs to be repaid to the bank. The liabilities section is showing us where the money has come from and what needs to be repaid in the future. And the assets section is showing where it is in the business. balance has been maintained as the total of the business's assets equals the total of its liabilities. Let's say you use the funds in the bank to buy a vehicle. When you buy a vehicle and pay for it in full, the bank balance will reduce, but the cash has been invested in a vehicle, a different type of asset. The equal and opposite effect is a reduction in the value of one asset and an increase in the value of another. So the asset total is still £70,000. There's balance as no adjustment has been made in the liabilities section. Get ready to pause the video to give yourself time to read and answer the question. In this example, the bank balance reduces by £14,000 and it is replaced with another asset, the office equipment. Balance is maintained as the total of the assets is still equal to the total of the liabilities. Get ready to pause the video to give yourself time to read and answer the question. The loan repayment is paid through the bank, reducing the bank balance, and the debt is reduced by the same amount. Although the totals of each section has now changed, balance is still maintained. Get ready to pause the video to give yourself time to read and answer the question. In this example, the change is in the liabilities section. The loan repayment will reduce the amount owed by £500, but it is replaced with credit card debt. The balance between assets and liabilities is still maintained. Throughout all of the activities, even though there has been changes in assets and liabilities, equity remains at £50,000. Another way to check the accuracy of your bookkeeping is to check this using the accounting equation. If the balance of equity does change when it's not intended, then a bookkeeping error has been made. The balance of equity will change over time. For example, investors may want to invest more. They may withdraw from capital. Capital grows when profit is made and retained in the business, and it reduces if the business is loss-making. To summarise, in this lesson we've learned that every business transaction causes a dual effect, which are equal and opposite, and the purpose of the double entry bookkeeping system is to record this. I hope you've enjoyed learning about the dual aspect of double entry. In the next lesson, you'll be using asset and liability ledger accounts to record business transactions. Welcome back. In this lesson, the aim is to learn about how the dual aspect of business transactions is recorded in the double entry bookkeeping system. You need to be able to identify whether accounts are asset and liability accounts, whether they are debit or credit records, so that you can enter business transactions accurately. You'll need to be able to calculate the balance on an account so you can explain what it means, as well as identify where it will be recorded in the statement of financial position. In the previous lesson, we learned about the dual aspect of double entry, how every business transaction causes a dual effect. The effects are equal and opposite, and how the total of business assets will always equal the total of its liabilities. Get ready to pause the video to give yourself time to read and answer the question. £50,000 has been paid into the business's bank account creating an asset. You've effectively lent the business money, creating a liability. The liability is recorded as equity or capital. The processing of business transactions in a double entry bookkeeping system needs to be well thought out, particularly when you're learning. I'll be constantly encouraging you to continually question what you've done and why, as well as get into the habit of double checking your work. We'll begin with questioning whether the effects of the transaction recorded from the previous question are equal. They are, as it's been recorded in two places, using the same amount. The effects are opposite. An asset and liability have been created. The business having cash is the opposite to having a financial obligation. In a double entry bookkeeping system, we use debits and credits to record the opposite effects. Debit records are used to record changes in the value of assets, and credit records are used for liabilities. The double entry bookkeeping system is ancient. The words debit and credit come from the Latin language and have unique meaning in accounting. There are several interpretations of the words. Most commonly, credit is thought to mean entrusted or given. In this example, £50,000 has been entrusted to the business. And a debit record shows what's been received for which something must be due. The business has received £50,000. We record transactions in ledger accounts. When we want to prepare a statement of financial position, these accounts are balanced and the total value of the asset or liability is written on the report. How we enter transactions into them will depend on whether they are debit or credit records. Let's first look at how we record transactions in asset accounts, debit records. The business needs to keep its own record of money that passes through the bank, so it keeps a bank account in the ledger. A ledger used to be a book. You'll notice that the left half of the account is labelled debit, sometimes abbreviated DR, and the right side of the account is labelled credit, CR. Cash is a business asset. A business asset is always recorded on the debit side of the account. So in this example, the business has recorded in its own accounting records that it's holding £50,000 at the bank. When the business receives money, it continues to record receipts on the debit side, adding to the account balance. We can calculate the balance on the account, that's the total amount held at the bank, by adding up all of the deposits, the debit entries. The revised bank balance is £52,500. We have a credit side on the account so that we can reduce the value of assets. It's thought that plus and minuses didn't exist when this system was established. Cash withdrawals and payments will reduce the bank balance. To recalculate the account balance, we deduct the payments, the credit entries, from the debit entry total. The revised account balance is £51,650. You might like to pause the video sometimes to make notes, think more carefully about these entries and carry out the calculations for yourself. A good bookkeeper or accountant always double checks the accuracy of their work. Look at the account balance and consider whether the bank balance is what you'd expect it to be. considering the transactions you've posted. If you're not sure, question your entries, and if necessary, recalculate the balance. It's essential you think logically and critically to work accurately. The ledger account will be balanced regularly. We've learned that assets are recorded as debits, so any opening balance on the account will be on the debit side. The opening balance here tells us that the business has an asset in the form of cash of £51,650 at the bank. This is the amount that would be recorded in the assets section of the statement of financial position if we were to prepare it now. Get ready to pause the video to give yourself time to read and answer the question. The opening balance, the amount held in the bank, is on the debit side of the asset account. Receiving money increases the bank balance, so the loan and the receipt from the customer are also recorded on the debit side. Any payments will reduce the amount in the bank, so the payment for the vehicle and tools are recorded on the credit side. To calculate the balance, we total the debit entries and deduct the total of the credit entries. The amount held in the bank is calculated as £70,250. Did you remember to check that this figure looks reasonable? It will be recorded in the Assets section of the Statement of Financial Position. The bank account is one of the few ledger accounts that could have an opening balance on the opposite side of the account. We do not use brackets or minus signs in ledger accounts, so overdrawn balances are recorded on the credit side of the bank account. An overdrawn bank balance would therefore be recorded in the liability section of the Statement of Financial Position, as you need to report that the business owes the bank £500. We still use the account in exactly the same way. Payments will still be recorded on the credit side and receipts on the debit side. Think logically when calculating the account balance. If we spend £100, we will owe the bank £600. If we receive £100, then the amount we owe will be reduced and we will owe the bank £400. So that leads us nicely onto learning about liability ledger accounts, which are credit records. Liabilities are recorded as credits. The capital you introduced is recorded in the capital account as a credit. Further investments are also recorded as credits. To calculate the total amount invested, we add up all the credit entries. Recording it in the liability account shows the readers of the Statement of Financial Position that £80,000 is owed to you or other investors. The debit side of the account is used to record transactions that reduce the amount owed to you, the investor. For example, you might take back £15,000. To recalculate the balance on the account, we deduct the debit entry from the total of the credit entries. The revised account balance, the amount owed to you, is now £65,000. Get ready to pause the video to give yourself time to read and answer the question. The amount of capital you originally provided to the business was £50,000. The additions from you and your friend are added to the balance on the credit side. Withdrawals are recorded on the debit side. To recalculate the balance, total what's been received, the credit entries, and deduct what's been withdrawn, the debit entry. The business now owes you and your friend £90,000. It's recorded as a liability in the statement of financial position. We've just double entered a business transaction. The amount received is an asset to the business in the form of cash, so it's recorded as a debit in the bank account. The amount given is a liability, as it belongs to the investors, so it's recorded as a credit in the capital account. It's good practice to indicate the source and destination of the transaction. So in the bank account, we've written that the amount has come from the capital account, and in the capital account, that the amount has been recorded in the bank account. As a reminder, we can prepare a statement of financial position at any point in time. The accounts in the ledger are totalled, balanced, and the totals are recorded in the relevant section of the report. The amounts are equal and opposite. So the balance between assets and liabilities has been maintained. It's good to use ledger accounts when learning double entry, as they provide a good visual, and for some they're easier to work with. Sometimes you'll see double entry listed rather than entered into ledger accounts. The first column is showing the account in which the entry will be made, then whether it will be entered in that account as a debit or credit. Whilst you're learning, you can choose which method works best for you, but eventually you'll need to be able to work with both methods. Let's remind ourselves that equal and opposite transactions can be double entered in any combination of accounts. Here we have a bank account which shows the business holds £25,000 in the bank. If the business were to purchase computer equipment costing £2,500, we reduce the bank balance with a credit entry, and we record that the business now owns computer equipment. We've exchanged the asset of cash for a physical asset. Get ready to pause the video to give yourself time to read and answer the question. The amount received is paid into the bank, increasing the asset of cash, so a debit entry is made in the bank account. Customer debt is an asset. The credit entry in the customer's debt account reduces the amount they owe. The revised bank balance is £25,250. The revised customer debt balance is £3,250. Here we have two liability accounts. The credit card account is showing that the business owes £8,900 on its credit card. The loan account is showing that it owes the loan provider £15,000. Crediting these accounts will increase the business's liability, the amount owed. Debit entries will reduce the debt. Get ready to pause the video to give yourself time to read and answer the question. The credit card company has given the business £300 to pay the loan, so the credit card debt increases by £300, a credit entry. The loan provider receives £300, reducing the business's liability, a debit entry. The credit card debt is now £9,200. The lender is now owed £14,700. Double entry is much easier to work out when there are account balances in the accounts already, and in a real set of accounts you'll be able to see them. When studying, they don't make it that easy for you. It's best to take a methodical approach when processing transactions. The first step is to consider whether you're using an asset or liability account. Then, establish which side you'd expect to see the opening balance on. An asset account is a debit record, so you'd expect to see the opening balance on the debit side. A liability account is a credit record, so you'd expect to see the opening balance on the credit side. Then establish whether you need to increase or reduce the account balance. In an asset account, debits will increase the account balance, the value of that asset. A credit entry has the opposite effect and reduces it. In a liability account, further credit entries will increase the account balance, the liability, and debit entries will reduce it. And the final step is to identify the dual aspect. Get ready to pause the video to read and answer the question. When there's no bank balance in the account, I recommend assuming there's money in the bank so you can apply the rules of an asset account. The cash account is also an asset account, so in both of these accounts you'd expect to find the opening balance on the debit side of the accounts. Making a debit entry increases the bank or cash balance, and a credit entry decreases it. Withdrawing cash from the bank reduces the bank balance, so we make a credit entry. Putting cash into the safe increases the amount of cash held on the premises, so we debit the cash account. Here we've moved the asset of cash from the bank account to the cash account. I compare learning double entry to learning a new language. You're not going to master it immediately, but you will in time. The only way to become proficient is to study in bite-sized chunks, practice and reflect on what you've learned, and rest in between sessions to give yourself time to process and store new skills. So please take the time to do this before you move on to the next lesson. I hope you've enjoyed learning double entry using asset and liability accounts. In the next lesson, we will be learning about how to record income in the double entry bookkeeping system. Welcome back. In this lesson, the aim is to learn about how income is recorded in a double entry bookkeeping system. You need to be able to identify income, double enter cash and credit sales, process receipts for credit sales, calculate and explain account balances and state where they'll be recorded. In the previous lesson, we learned about double entry when using asset and liability accounts. Asset accounts are debit records and liability accounts are credit records. The opening balance on an asset account shows the value of assets in that account and is on the debit side. Further debits will increase the account balance, the value of the assets. Credit entries have the opposite effect and reduce it. The opening balance on a liability account shows the total amount of debt the business owes, and it's on the credit side. Further credit entries increase the account balance, the amount of debt owed. Debit entries will have the opposite effect and decrease it. In the next two lessons, we're going to be learning about how to account for income and expenses, which are recorded in the statement of profit or loss and are used to calculate profit or loss. Income accounts are credit records. The business is providing goods or services to others. And expenses are debit records. The business is receiving goods or services for which something must be due. We have to work with all four account types when accounting for income and expenses, so double entry can start to feel more challenging. So in this lesson, we'll just be focusing on accounting for income. When the business sells a product or service, it's always recorded in the sales account. At the end of an accounting period, the total on this account will be used to calculate profit. Recording the equal and opposite effect depends on the type of sale. For example, a supermarket's customers are all likely to pay for what they buy immediately. We call this type of transaction a cash sale, even though they might pay using debit or credit card. The money that passes through the bank is recorded in the business's bank account. If the business keeps the cash it's received on the premises, it's recorded in a cash account. Here you can see why we need these accounts. Let's say the accounts are balanced at the end of the month. The sales account will tell us how much the business has earned from selling goods and services during the accounting period. The bank account tells us what the bank balance is. And the cash account tells us how much cash is held on the premises. Each account serves a completely different purpose. Get ready to pause the video to give yourself time to read and answer the question. £4,500 is added to the sales account balance, giving a revised balance of £104,500. This is the business's turnover, total sales to date. £4,500 is added to the bank balance, giving a revised balance of £24,500. We'd only use the cash account if the business kept some cash on the premises. You've already learned how to process transactions in debit and credit records. Debit records are used to record assets and expenses, and credit records are used to record liabilities and income. Make a note of this as you'll keep needing to refer to it to answer the questions that follow. Get ready to pause the video to give yourself time to read and answer the question. The sales account is a credit record, so the opening balance is on the credit side. The business has sold £100,000 worth of goods or services to date. We need to increase it by £4,500, so we credit it. The equal and opposite entry is debited to the bank, but let's think about this carefully. When there's money in the bank, it's a debit record, so the balance is on the debit side. The funds are paid into the bank, which increases the bank balance, so that's why it's debited. It's so important to continually check your work because it's so easy to make a mistake in a double entry bookkeeping system, particularly when you're learning. Calculate the account balances to see if what you've done makes sense. The balance on the sales account is £104,500. Do the same for the bank account. The balance is £24,500. Finally, check the entries balance. They do, as £4,500 has been debited and credited in two accounts. Frequently, double entry is reversed. An error like this would reduce sales by £4,500 to £95,500 and reduce the bank balance to £15,500. Again, carrying out simple checks frequently can help you to work more accurately, and double entry will make more sense. Get ready to pause the video to give yourself time to read and answer the question. Sales increase by £25 to £104,525 and the cash account increases to £525. Get ready to pause the video to give yourself time to read and answer the question. The sales account and income account is credited with £25, but this time the cash account is debited rather than the bank account. The income account shows the balance as £104,525 and the asset account balance, the debit record, is £525. Get ready to pause the video to give yourself time to read and answer the question. The sales account is a credit record with an opening balance on the credit side. We need to add the additional sales by crediting the account. The bank account and cash account are debit records, so the balances are on the debit side. We need to add the money received to those balances by debiting the accounts. Did you remember to check the entries you've made balance and check the account balance makes sense? Sometimes in a double entry bookkeeping system, you'll see the total recorded in one account. So £6,000 has been recorded in the sales account. Then how the money has been distributed is recorded in the other accounts. £5,000 was banked and £1,000 cash was retained. There are circumstances where this is all right, providing the entries balance. They do, as the debits total £6,000, which is equal to the credit entry. There's a mnemonic that helps us use double entry accounts correctly. Expense, asset and drawings accounts are debit records. When we debit them, we increase the account balance. Liability, income and capital are credit records. When we credit these accounts, we increase the account balance. Making an opposite entry reduces the account balance. Make a note of dead click, as you'll find it very useful to refer to. Get ready to pause the video to give yourself time to read and answer the question. The sale is recorded in the sales account. It's an income account, so a credit entry increases the account balance, adding £10,000 to the amount of sales made to date. £9,500 was banked. Cash is an asset, so debiting the account increases the account balance. That's the amount of money at the bank. The cash account is also debited with £500. The entries balance as the total of the debit entries equal the credit entry of £10,000. Many businesses buy and sell on credit, meaning the supplier has agreed to the goods and services being paid for in the future, often 30 or 60 days later. It's important that the business keeps a record of these debts. All sorts of terminology is used to name the account used to record customers' debts. We'll keep it simple and name the account Customers' Debts. Get ready to pause the video to give yourself time to read and answer the question. We record the sale by adding £300 to the sales already made during the period, so the revised balance is £75,300. Customers owe the business £2,500. That now increases to £2,800. Get ready to pause the video to give yourself time to read and answer the question. Did you remember to question what you've done rather than double enter on autopilot? We need to increase the amount of income the business has earned by crediting the income account, the credit record, and increase the amount customers owe by debiting the customer's debts account, which is the asset account and debit record. The account balances are now £75,300 and £2,800. Get ready to pause the video to give yourself time to read and answer the question. The debt needs to be removed from the customer's debt account. Customers did owe £2,800. They now owe £1,800. £1,000 needs to be added to the bank account, so the revised balance is £14,500. A common error is for the sales account to be adjusted. The invoices were recorded in the sales account when the goods and services were provided around 30 days ago. If we record this transaction again as a sale, we'll duplicate the original transaction. Get ready to pause the video to give yourself time to read and answer the question. We debit asset accounts to increase the account balance, what customer owes us. We need to reduce it, so we credit it. Let's do a check. The balance on the account can be calculated as £2,800 minus £1,000 equals £1,800. The bank balance needs increasing, so we debit it. The balance is now £14,500. Get ready to pause the video to give yourself time to read and answer the question. To increase the amount in the income account, we record the sale as a credit. To increase the amount customers owe us, we debit the customer's debt account as it's an asset account. No entries are made in the bank account as no money has been received yet. Get ready to pause the video to give yourself time to read and answer the question. Debiting the bank account increases the bank balance, the asset of cash, by £425. The customer's debt is on the debit side of the asset account. The balance needs reducing, so we credit it. Let's do two simple checks. The entries balance and the balance on the customer's debt account looks reasonable. It can be calculated as £850 minus £425 equals £425 outstanding. Do ensure you make a note of the mnemonic dead click, as it will help you use the double entry accounts correctly. In this lesson, the income account we used was a sales account. It's worth noting that other forms of income are recorded in exactly the same way. The asset accounts we used were customers' debts, bank and cash. I hope you've enjoyed learning about how to record sales in the double entry bookkeeping system. In the next lesson, we will be learning about how to record expenses. Welcome back. In this lesson, the aim is to learn about how expenses are recorded in a double entry bookkeeping system. You need to be able to identify expenses, double enter cash and credit expenses, process payments for expenses on credit, calculate and explain account balances, and state where they'll be recorded. In the last lesson, we learned about how to process cash and credit sales and how to process a receipt when a customer settles a debt. Let's see how much you can remember. Get ready to pause the video to give yourself time to read and answer the question. Let's first remind ourselves that the asset accounts listed are debit records and are recorded in the statement of financial position. The sales account is an income account and is recorded in the statement of profit or loss. We learned a useful mnemonic dead click. Debit, expense, asset and drawings accounts to increase the account balance. Credit, liability, income and capital accounts to increase the account balance. To reduce an account balance, make an opposite entry in the account. The customer pays immediately when it's a cash sale. We debit the bank to record the receipt, which increases the asset of cash. We credit the sales account to record the increase in income. The customer is invoiced and agrees to pay at a later date when it's a credit sale. We need to record the customer's debt, which is a business asset, by debiting the customer's debt account. Again, the sale is credited to the sales account to record the increase in income. For the last transaction, we debit the bank to record the increase in the asset of cash and remove the debt from the customer's debt account by crediting the asset account. In this lesson, we're going to learn about how to process business expenses, starting with purchases. First, we need to be clear about what purchases are. We need to use a purchases account to record the total cost of buying stock during an accounting period. Stock could include materials used to make goods, which will be sold to customers, or ready-made goods. So in this example, the business has spent £150,000 in, let's say, the last year. During the year, much of this will have been used or sold on to customers, but we still need to know how much it costs so we can calculate profit. It's quite different to the inventory or stock asset account, which is used to show the value of stock held on the day that the statement of financial position is prepared. So in this example, the business has spent £150,000 buying stock throughout the year, and only £12,500 worth remains in stock. You'll only use the purchases account when beginning to learn double entry bookkeeping. We record all stock purchases in the purchases account. For a cash purchase, there's no credit agreement involved. The business pays immediately, so we use the bank account or the cash account to record the payments. Let's remember that the balances on these accounts tell us what the bank balance is or how much cash is held on the premises. Get ready to pause the video to give yourself time to read and answer the question. We need to increase the cost of purchases by £2,000 to £152,000 and reduce the bank balance for the payment from £15,000 to £13,000. Get ready to pause the video to give yourself time to read and answer the question. Did you notice you're working with two debit records? The purchases account is an expense account, so the opening balance is on the debit side. We need to increase the cost of purchases by £2,000 with a debit entry. The equal and opposite entry is in the bank account, but let's consider why. The business has £15,000 in the bank. A payment reduces the bank balance, so a credit entry will reduce the asset of cash. Let's do our good practice checks. We have two balancing entries, one debit and one credit. To calculate the balance on the purchases account, we add up the debit entries. The total is £152,000. To calculate the balance on the bank account, we deduct the credit entry from the debit entry. The total is £13,000. For a credit purchase, there's an agreement involved, as the business pays usually around 30 to 60 days later for its stock. We use a supplier's debt account to record what the business owes to its supplier. Let's remember that the balance on the debt account tells us what the business currently owes. Get ready to pause the video to give yourself time to read and answer the question. We need to increase the cost of purchases by £6,000 to £158,000 and increase the amount of debt owed to suppliers by the same amount, so the business now owes £14,500. Get ready to pause the video to give yourself time to read and answer the question. To increase the cost of purchases, debit the purchases expense account. The supplier's debt account is a liability account with a credit balance. To increase the amount of debt owed to suppliers, we credit it. Let's do our good practice checks. We've made equal and opposite entries. The total on the purchases account is £158,000 and the total on the supplier debt account is £14,500. When the business settles the debt, we need to record the payment using either the bank or cash account, as well as reduce the debt. We need to remember not to use the purchases account. The invoice was recorded in the purchases account when it was received, probably 30 days ago. If we use this account again, we'll duplicate the original transaction. Get ready to pause the video to give yourself time to read and answer the question. There's £13,000 in the bank. The supplier is being paid £4,500, so the bank balance reduces. A credit entry in the bank account reduces the asset of cash. Suppliers are owed £14,500. They're being paid £4,500, so the amount owed reduces. A debit entry in the supplier's debt account reduces the liability. Did you remember to do the good practice checks? The bank balance is £8,500 and the supplier debt balance is £10,000. Get ready to pause the video to give yourself time to read and answer the question. Don't forget to use the mnemonic dead click to help you work more accurately. All of the purchases are recorded in the purchases account. We debit the account as the opening balance would be on the debit side. we apply the rules of an asset account to the bank account, so the bank balance will be also on the debit side. £275 was paid for cash purchases, so we reduce the bank balance by crediting it. The supplier's account is a liability account, so the opening balance will be on the credit side. The business was invoiced £9,150 for credit purchases, so we record the increase in debt by crediting the liability account. Get ready to pause the video to give yourself time to read and answer the question. We apply the double entry rule for an asset account to the bank account, so the balance will be on the debit side. The payment reduces the bank balance, so we need to make a credit entry. The equal and opposite entry is in the supplier's debt account, but why? It's a liability account with a credit balance. We need to reduce what's owed to suppliers, so we make a debit entry. Other expenses are accounted for in exactly the same way. However, the business may use a liability account for trade suppliers, so that's the suppliers that they buy stock from, and a different account for other types of suppliers. Get ready to pause the video to give yourself time to read and answer the question. These are all credit invoices, so we record the debt in the supplier debt account. It's a liability account, so the balance would be on the credit side. To increase the liability, we credit it. The equal and opposite entries are in the relevant expense accounts. Expense accounts have debit balances, so we debit them to add to the business's expenses. We haven't yet paid for these invoices. At the end of the month, the invoices are settled. The debt is on the credit side of the other supplier's debt account. We need to remove it by making a debit entry. The equal and opposite entry is recorded in the bank account. We apply the rules of an asset account to the bank account, so the balance would be on the debit side. The credit entry reduces the asset of cash held at the bank. We do not need to record anything in the expense accounts, as if we do, then we'll duplicate the original transactions. In this lesson, we've learned how to double enter expenses. Here is a summary of the accounts we've used in the last 2 lessons. I hope you've enjoyed this lesson. In the next lesson, we'll be learning about the double entry required when goods are returned to suppliers or when goods are returned by customers. Welcome back. In this lesson, the aim is to learn about how to process sales and purchase returns. You need to be able to double enter returns for both sales and purchases and for cash and credit transactions. Sometimes stock needs to be returned. Perhaps it's faulty, not expected, or not needed anymore. Have you returned goods? If you have, you've probably noticed that the business insists that the refund is provided using the same method in which you paid. This is actually a procedure to deter fraud, but it also helps the business to account correctly for the refund. To account for returns, the business usually reverses the original transaction. The sale was recorded as income and the cost of stock was recorded as an expense. When goods are returned, the transaction needs to be reversed or removed. For cash transactions, a refund can be provided using the bank or cash account. For credit transactions, a credit note is issued which reverses the invoice that was posted, so it reduces the amount of debt owed. Get ready to pause the video to give yourself time to read and answer the question. The business has recorded that it sold £500,000 worth of goods so far. This needs to be reduced by £5 for the item that has been returned. The business is holding £100 cash. The customer is refunded using the method in which they paid. The cash balance will reduce to £95. Later in your studies, you'll learn that these little transactions are actually grouped together and recorded in bulk, usually at the end of the day, rather than a chicken at a time. As a reminder, throughout this lesson, we'll be using the mnemonic dead click to help us double enter accurately. I've listed the accounts we will be using. You might want to make a note of them before we move on. You've learned that the sales account is an income account and a credit record, so the opening balance is on the credit side. To reduce the balance on an income account, we make an entry on the debit side. So the refund is recorded as a debit. This gives the account balance we are expecting, £499,995. It's perfectly acceptable to account for returns like that. However, businesses like to separate sales and sales returns. The sales returns account is a debit record, as it provides a place to enter the transactions that would normally be entered on the debit side of the sales account. We can see here that the business has actually already recorded £24,995 worth of returns. Returning the chicken will increase the amount to £25,000. The figure that will be entered into the statement of profit or loss is calculated by totalling each account and deducting one total from the other. The actual figure to be entered in the statement of profit or loss is £475,000. Separating returns from sales provides the business with more helpful information. For example, they're likely to measure quality by comparing what's been returned to what's been sold. If we put all of the transactions into one account, this comparison would be more difficult to do. Get ready to pause the video to give yourself time to read and answer the question. The return is added to the sales returns account, giving a revised balance of £25,100. The revised total for sales is calculated as total sales less sales returns, giving us £474,900. The refunds are provided through the bank, which will reduce the bank balance to £69,900. Get ready to pause the video to give yourself time to read and answer the question. The sales returns account provides the debit side of the income account, so the opening balance is on the debit side. The return is added to the opening balance with a debit entry. The balance on the account is now £25,100. The bank is a debit record too, as whilst we are learning, we assume there's money in the bank, asset of cash. The bank balance needs reducing with a credit entry. Get ready to pause the video to give yourself time to read and answer the question. The return is recorded in the sales returns account. So the total for sales returns increases to £500. The revised sales figure for the statement of profit or loss is now £74,500. The business invoiced the customer for the taps, so the debt is in the customer's debt account. It needs removing. Customers now owe £4,800. Get ready to pause the video to give yourself time to read and answer the question. The sales returns account is a debit record with a debit opening balance. We add £200 to the opening balance with a debit entry. The balance is now £500. The customer's debt account is also a debit record as it's a business asset. To reduce the amount customers owe, we credit it. The balance on this account is now £4,800. We never use the debit side of the sales account. Get ready to pause the video to give yourself time to read and answer the question. The sales returns account is a debit record. The opening balance is on the debit side. We need to add the additional returns to it with a debit entry. Credit customers were invoiced £500 for the goods they returned, so the invoice is in the customer's debt account. The account is an asset account, a debit record with an opening balance on the debit side. We need to reduce the debt owed, so we make a credit entry. The customers that paid immediately for the goods need to be refunded through the bank. The bank is a debit record, so we credit it to reduce the asset of cash. Did you check that the entries balance? We account for purchase returns in exactly the same way. All returns are added to the purchase returns account, and the equal and opposite entry will depend on whether the business paid the supplier immediately for the purchase or whether they were invoiced on credit. Before we do more questions, let's remind ourselves that the supplier's debt account is a liability account, a credit record with an opening balance on the credit side. We assume there's money in the bank, so the asset of cash is recorded on the debit side of the bank account. Purchases are an expense, a debit record with an opening balance on the debit side. The purchase returns account provides the credit side of the purchases account, so the opening balance will be on the credit side. Get ready to pause the video to give yourself time to read and answer the question. All of the returns are added to the purchase returns account, giving a revised balance of £1,550. The revised balance for total purchases is £48,450. £150 will be refunded to the bank account. The refund will increase the bank balance, so the revised bank balance is £7,350. The wholesaler invoiced the business £1,000. The invoice will be in the supplier's debt account. This needs removing. The balance will decrease by £1,000, so the business will now owe its suppliers £3,000. Get ready to pause the video to give yourself time to read and answer the question. All of the returns are added to the purchase returns account. Let's remember the purchases account is an expense account, a debit record with an opening balance on the debit side, and the returns account provides the credit side of this account. The cash refund is debited to the bank account to increase the bank balance, the asset of cash. The invoice for the credit purchase is on the credit side of the supplier debt account. The liability needs removing with a debit entry. Finally, always check that the entries balance. The total of the debit entries equal the total of the credit entries. Get ready to pause the video to give yourself time to read and answer the question. Purchases are an expense, a debit record. The purchase returns account provides the credit entry for this account. We add all the purchase returns to the purchase returns account with a debit entry. The refund is debited to the bank account to increase the bank balance, the asset of cash. The invoice, the liability, is on the credit side of the supplier's debt account. It needs removing with a debit entry. Finally, did you check that the entries balance? Get ready to pause the video to give yourself time to read and answer the question. The sales account is an income account, a credit record. The sales returns is its opposite. We add all of the sales returns to the sales returns account with a debit entry. The refund for the cash sale is provided through the bank account. It's credited to reduce the asset of cash. The invoice for the credit sale is on the debit side of the customer's debt account, an asset account with a debit opening balance. We reduce the debt with a credit entry. Finally, did you check the entries balance? I hope you've enjoyed learning about how to account for sales and purchase returns in the double entry bookkeeping system. The next lesson is the final lesson, and we'll be looking at how to balance accounts properly and how to identify the figure that is recorded in the financial statements. Welcome back. In this lesson, the aim is to learn about how to balance accounts properly and extract figures for the financial statements. In this course, you've learned about two key financial statements that are prepared at the end of an accounting period. The statement of financial position lists the business's assets, items that have a cash value, and liabilities, the business's debts. The liabilities, which include equity or capital, are credit records, showing what has been entrusted to the business. The assets section shows where it is in the business, and these are debit records. The statement of profit or loss is used to calculate whether the business is profitable or not. The income accounts are credit records, and expense accounts are debit records. There is an account in the double entry bookkeeping system for everything listed in these financial statements. The statement of profit or loss covers a period of time, for example, what's been earned and spent during the last year, and the statement of financial position shows what the asset and liability balances are on the day that it is prepared. We use the mnemonic DEAD-CLICK to help us use these accounts in the right way. The accounts we've been using are listed, but there are many other accounts in a business's double entry bookkeeping system. Throughout your career, you'll encounter accounts you've not used before, and that's why it's important for you to be able to classify them correctly. Now we'll look at how a debit and credit account is balanced and how the balance is extracted and entered into the relevant financial statement. The statement of financial position is dated the day it is prepared. This tells a manager that on the 31st of January 21, the business's vehicles cost £15,000. The amount has been taken from the vehicles account. The opening balance on account is dated on the first day of an accounting period. An opening balance is written as balance brought down or balance brought forward, rather than opening balance. We'll see why in a moment. In a manual bookkeeping system, a business may balance its accounts at the end of every day, week or month. It depends on the volume of transactions. Let's read this account before we look at how to balance it. The opening balance tells us that the business's vehicles cost £15,000. On the 8th of February, the business sells the vehicle and it's removed from the account. 2 new vehicles are purchased on the 10th and the 15th of February. What's the balance on this account? Pause the video and give this some careful thought before you move on. The account balance is calculated by adding up the debit entries and deducting the credit entry to give a balance of £54,000. The reason for asking you to do this is because sometimes logic goes out of the window when people start to learn to balance accounts in the proper way. Let's look at this account more carefully. The vehicle that the business had at the start of the month was sold, so the account balance is the total of the 2 vehicles left in the account. To close the account at the end of February, we write the balance on the side that has the lowest total to create balance in the account. Then, as a double check, we total each column. Each column total should be the same. If it's not, then an error has been made. This is why it's called balancing an account. We are creating balance in the account. Balance carried down means closing balance. On the 28th of February, the closing balance is £54,000 and it is carried down or carried forward to the next month. Therefore, on the 1st of March, the balance is brought down or brought forward from the previous month as an opening balance for March. The account is now ready for any transactions that happen in March. The statement of financial position is usually prepared at the close of business, so the cost of the business's vehicles is transferred to the statement of financial position on the 28th of February as £54,000. I can't emphasise enough how important it is to think logically about what you're doing. I see all sorts of balancing errors, which often result in the incorrect figure being entered into the statement of financial position. Here, for example, a column total has been written in the wrong place and has been transferred to the statement of financial position. There are some simple checks you can do to check the accuracy of your work. The column totals must agree, they must be the same. The opening and closing balances must be the same and they must be on opposite sides. And finally, an asset account is a debit record, so the opening balance should be on the debit side. Get ready to pause the video to give yourself time to read and answer the question. Let's read the activity in this account before we review how to present the balance properly. The opening balance tells us that prior to March the 1st, the business has spent a total of £500 on advertising. During March, it has received a further 3 invoices. So far, the business has spent £2,000 on advertising. Then, it receives a credit for an error. We can already see that the account balance on this account is £1,750. We write the account balance on the side with the lowest value to create balance in the account and date it the last day of the month. Then we total the two columns to show that it balances and transfer the balance to the debit side of the expense account, dating it the first day of the following month. Let's do our good practice checks. The column totals agree. The closing and opening balances are the same and on opposite sides. The opening balance is on the correct side, as advertising is an expense, a debit record with a debit opening balance. The business can prepare a statement of profit or loss that covers any period of time. This one is telling us that so far this year, that's up to the 31st of March, £1,750 has been spent on advertising. So far we've balanced an asset and expense account, which are both debit records. A credit record is balanced in exactly the same way. If a business earns income from commission, it will record it in a commission received account, an income account with a credit opening balance. This account tells us that £2,000 commission has been received prior to the 1st of February. Then, on the 5th of February, a further £500 was received. For some reason, £50 has been removed from the account, so the total amount received can be calculated as £2,450. The closing balance is entered on the debit side of a credit record, so the opening balance can show correctly as a credit. Get ready to pause the video to give yourself time to read and answer the question. On the 1st of March, the business owed suppliers £9,300. On the 3rd of March, a credit note was received for goods that had been returned, totalling £150. On the 27th of March, suppliers were paid £5,000. The account balance is calculated as £4,150. It's entered on the side of the account with the lowest value. The columns are totalled to ensure that there's balance in the account. The balance is transferred to become an opening balance. It's on the credit side of the account as it's a liability account. At the close of business on the 31st of March, the business owes suppliers £4,150, and this is recorded in the liability section of the statement of financial position if it were to be prepared. A few other things to note that are in a manual bookkeeping system. The next entry is always written on the next available line. We don't leave any gaps to avoid people incorrectly or fraudulently adding things into the account. The column totals are always opposite each other. I hope you've enjoyed learning about how to balance accounts. This was the final lesson, and I truly hope you've benefited from learning about the double entry bookkeeping system with me. If you think this course will benefit others, I'd be most grateful if you could recommend it, and please leave a review.